Both tile and paint, it's a lovely question. It is really testing a lot of the knowledge that you should have by now. So it is a very, very good question for practice exercises. Both tile and paint have been operating since 2006 and is owned by Mr. Jim Storm. BTP is located in an upscale community and sells high quality goods. Besides selling tiles, paint and bathroom accessories, they also have a division to do small-scale installations for homeowners. Mr. Storm had always been a hands-on owner and was always at the shop supervising all aspects of his business. In February 2016, he went on an overseas trip, leaving the supervision to his senior employees. In late March 2016, he came back to the country and returned to his normal work routine. Unfortunately, he discovered that some of whom he thought were loyal employees took advantage of his absence. Both the inventory supervisor and his accountant were suspended in May 2016, pending a disciplinary hearings for their alleged misconduct. During April, both employees had become aware of Mr. Storm's suspicions and tried to cover up their wrongdoings. The accountant, Mr. Rain, became particularly nervous and made many errors in the books. Mr. Storm contacted All for One Accountants Inc., where you work as a second-tier accounting clerk to assist with the finalization of the financial statements. You were very excited about given the responsibility of assisting this client and immediately viewed the information Mr. Storm supplied. Mr. Storm supplied with a trial balance as at 30 April 2016. Let's go to the required parts so that we know exactly what to look out for. Prepare the statement of profit or loss and other comprehensive income for the year ended 30 April 2016. Comparative figures are not required. Great. Let's have a look what is now included in our trial balance. Cash on hand, fixed deposit, 11% due on 1 May 2017. Property, plant and equipment, book value, trading stock, and here's 30 April 2015, so clearly opening inventory. Stationery on hand, 30 April 2015, opening inventory. Bank overdraft, prepaid advertising, that's a bit of a funny in a pre-adjustment trial balance. VAT control account, credit balance, capital drawings, long-term loan, regular bank, trade debtors, allowance for credit losses, trade creditors, allowance for settlement discount on the creditors. Now there's nothing that I see on the debtors. Income received in advance. Also a bit of a funny account in a pre-adjustment trial balance. Sales, installation income, clearly two sources of income streams that you have. Purchases, again periodic system, debt giveaway. Freight on sales, freight on purchases, consumables, salary and wages, depreciation, rent expense, interest on the 30-day deposit, 30,800. Now we have this fixed deposit here that is told us is 11%. So if we take the 11%, and the maximum that you can recognize in this year, they don't give me any further particulars on this fixed deposit in the question, but the maximum that you can earn is 12 months worth of interest. So let's assume it was a fixed deposit for 12 months, and you do that calculation, you will see that the maximum interest that you could have earned on that deposit was 30,800. So that absolutely agrees with that one. So this one is correct. I don't have to worry about this anymore. Other selling expenses, other admin expenses. BTP has a 30 April year end, well now that we've seen. And then they say that they're a VAT vendor and a VAT rate of 14% applies. All transactions should be recorded through a VAT control account. You can assume that all transactions are with other registered VAT vendors unless otherwise stated. Then they carry on with property, plant and equipment. Before his suspension, Mr. Rain had finalized all entries relating to property, plant and equipment, and you can accept that all the transactions were correctly recorded. So there we have depreciation in our books. So that means that that depreciation is correct. all entries have been done about the PPE items, so I can ignore that. So that whole first sentence is basically, well, I won't say worthless, but it just tells you that you don't have to do anything. Inventories. BTP use a periodic inventory system, well, so we've seen, and it values stock on the first in, first out basis. All inventories were counted on 30 April 2016 at year end, and the stock sheets revealed the following. Trading stock 124,000, stationery on hand 2,800, and consumables 3,200. Let's park trading inventory a little bit because this whole paragraph here is all about trading inventory. Stationery on hand at the end of the year was 2,800. If we run through our income statement items, I do not see any stationery. However, if I go a little bit up here, I see stationery on hand on 30 April, 10,600. So that means that I didn't incur any additional stationery cost in the current year. So that means that we have here, let's just create here a bit of space. At the end of the year, still stationery on hand of that stationery that we had in the beginning of the year. So our stationery expense for the year is going to be the difference between the amount that we had on hand in the beginning of the year, which was 10,600, less the amount that we have counted, 2,800 at the end of the year. So that means that we have actually used an amount of stationery equal to the difference between the two, and that gives us 10,600 less 2,800, 7,800 Rand expenses. The second one was our consumables. So we're going to debit a consumable stock, 3,200. So don't ask me the statement of financial position, but I have to reduce my consumable expense account, the amount still on hand at the end of the day. So I'm going to credit that account, 3,200. Good. Now let's talk about 124,000 Rand. Mr. Storm was concerned with the high value of trading stock reflected on the stock sheets. Now, if you look at the opening inventory on hand, it was 82,000. So suddenly it jumped to 124,000. He did a thorough investigation of the store area as he no longer trusted the inventory supervisor and he was not sure he could rely on the stock sheets that he was prepared. He discovered that included in the value of 124,000, there were 30 piles of luxurious silk white paint hidden in the back of the area where the lids had been removed and paint was missing from each pile. Each pile was 20 liters. So that means that basically there were 30 piles, each pile 20 liters. So the total number of liters is the 30 times the 20 equals 600 liters of paint. Good. The supply invoice was 1083 per pile. So the cost involved equals the 1083 supply invoice, so that will include the VAT. So when I take out the VAT, it gives me 950 Rand per pile. There are 20 liters in a pile. So 950 Rand divided by 20 liters will give us 47 Rand 50 cents per liter of paint. Cost price. Good. Since the lids were removed, the paint became contaminated with bits of dirt and could not be sold in the normal course of business. It was estimated that 140 liters of paint were removed. So if it were removed, it was stolen, it disappeared. So what was the cost involved for that 140 liters? 140 litres times 47 rand 50 gives us a total amount of 66, let's say 47.50 times 140, 6650. The value of the paint that was stolen. Mr. Storm contacted a friend in Johannesburg who said he could use the paint for his business and he will pay him 20 rand exclusive of that per litre if he would send the paint to his premises. So he will take the paint, but you have to deliver the paint. The cost of transporting all the paint was estimated to be 1140 inclusive of that. So if we're going to see what was the remaining number of litres left, we had 600 litres. 140 litres of that has disappeared in thin air, so we have left a total number of litres of 460. 460 litres at 47 rand 50 equals a cost price of 21,850 cost. Now, if we want to work out the net realizable value of that paint, what is that equal to? That equals then 460 litres times the estimated selling price exclusive of that, 20 rand a litre, and that equals 9,200 rand. And then, that is not where it stops. I also have to take the compulsory selling costs into consideration when I work out the NRV adjustment. So the compulsory selling cost exclusive of that, remember guys, inventory is always exclusive of that, is 1,000 rand. So the total amount that we can realize if we're going to sell that 460 litres of paint is 8,200 rand. So our total NRV adjustment will then be the difference between the cost price of 21,850 and the net realizable value of 8,200, and that gives us a total of 11,650. Right. Then it's all about the long-term liability and trade and other payables, etc., etc. I want us to do the first part of the income statement first because the rest of the question does not really have a lot of bearing on the first part of the income statement. Maybe it's not 100% right. Let me just show you how that inventory story is going to be panned out in the income statement. We're going to have sales and whatever we're going to do with sales. And here's our cost of sales. It's a periodic inventory system. Opening inventory, 82,000 rand. And they tell us where's the opening inventory there right at the beginning. Opening inventory, 82,000 rand. And then our purchases. Our purchases, they also gave us those amount. The purchases was the 1,480,000, there it is, and purchase-related cost was freight on purchases of 8,900 rand. So that's a purchase-related cost. You could have mentioned them in separate line items, it doesn't matter, but in total it is 1,488,900. The inventory loss, I have to record and I have to close it off against my trading account at least, which is going to be above the gross profit line. Why? Because it's got to do with trading inventory. So all the adjustments that I'm going to make to inventory or purchases or anything relating to my trading stock, I'm going to do it above the gross profit line. So the inventory loss is going to be that 140 litres which was lost in the whole process. And that there it is, the theft of 6650. So I'm going to show that as an inventory loss, which form part then actually as the cost of sales adjustment or the cost of sales calculation, 6650. Our closing inventory. Our closing inventory needs to be shown at the lower of cost or net realizable value. Now, we have inventory of 124,000 rand on hand, but we know that some of that inventory, 21,850 rand, included in the 124,000 rand, is not really worth 21,850. It is only worth 8,200. Therefore, my net realizable value adjustment will be passed. I'm going to credit my trading inventory, so that will be reduced with that amount 11,650, and the debit side will go against my income statement. So in total then, our closing inventory will be 110,350. Now guys, did I record my inventory somewhere separately? If you think about debits and credits, it is a periodic inventory system, so I don't have an inventory account. So what do I do at year end? At year end, I basically take my inventory and I'm going to record it for the first time in my books. When I value my inventory, I have to value my inventory at the lower of cost or net realizable value. The cost was 124,000 Rand, but some of the items there had a net realizable value which was 13,650 Rand less the cost. So I cannot bring into my statement of financial position inventory of 124,000. So I cannot pass debits and credits against anything. What am I going to do? When I'm going to record my closing inventory, I'm not going to record it at 124,000, but I'm only going to record it at 110,350. So therefore, there's no separate entry that will go through my books. If I had a perpetual inventory system, I would have had an existing balance as a closing inventory balance in my books. That then means that my general ledger account was totally incorrect, and that would then have meant that I would have passed the 13,650 Rand against that inventory account because it has a perpetual balance that's been kept updated with all the transactions that takes place. Because in that instance, I would have credited my general ledger account with 13,650 and I would have debited a net realizable value adjustment account with 13,650 and I would have shown that account here as part of cost of sales. But now I'm working on a periodic inventory system. So with a periodic inventory system, what do I do at year end? I just basically take the value of my closing inventory and I bring it into my books. So I'm going to debit cost of sales with the value of my closing inventory and I'm going to credit cost debit to inventory with the amount of 110,350 and credit cost of sales with the amount of 110,350. So please don't get confused. Don't try to pass a debit entry against anything because you have nothing to pass it against. Why not? Because I never had closing inventory in my books at this balance which was carried forward on a transaction per transaction basis. Good. That was now our inventory story in this question, which is really, really very good. Long-term liability. On 1 May 2013, BTB, now this is a long, long time ago, BTB bought specialized paint mixing machine with an invoice price of 96,900. A loan from regular bank was taken out for 70,000 Rand on 1 May 2013 on the same date with an interest rate of 14%. The loan is repayable over 10 years with a payment of 13,420 Rand per annum, including capital and interest on 30 April of each year. So capital and interest amortization table, which you will have to prepare. The scheduled payment was made on 30 April 2016 and Mr. Rain credited the bank and debited the loan. Okay. Now, there are a few things that you should have realized straight away here. Number one is that my outstanding loan is not 70,000 Rand anymore. It was 70,000 Rand on the 1st of May. But subsequent to the 1st of May 2013, I'm currently at the 30th of April 2016. So subsequent to that, I have made a couple of repayments. How much do I pay per annum? I pay 13,420 Rand per annum. So therefore, I must firstly determine what was the outstanding loan balance as at the beginning of the year. Now, this bookkeeper, Mr. Ryan, who is also stupid like all of them, what did he do? He credited bank with 13,420 on 30 April 2016, and that is correct. But he took the whole amount and he debited the whole amount against my loan account, 13,420. So as of 30 April 2016, this loan amount of 48,830, that includes our repayment that we've made for the current year. So if I want to know what's the outstanding loan account balance at the beginning of the year, I have to take that 48,830 and I have to increase it again with the amount that you offset it against that account at year end of 13,420. So that then gives me an outstanding loan amount of 48,830 plus 13,420, not minus, plus 14,320. He credited this account. He debited this account, so we're going to reinstate it now, 13,420. So that gave us an outstanding balance at the beginning of the year of 62,250. What should he have debited against the loan account? He should have debited against the loan account only the capital repayment. What did he debited against the loan? The full installment. So what am I going to take out of here? So what am I going to put back into my loan account? The interest portion. So the interest portion is going to increase the loan. So that's going to be a minus figure. And that interest that we have paid, that will then be here somewhere as an interest expense for the year. Right. So what do we have to do? We said we have to do our amortization table. Let's see. Opening balance, the 62,250, which is now the amount that we've reinstated with the repayment that he made during the course of the year. How are we going to calculate the interest and capital portion? Well, we're going to take the outstanding capital amount in the beginning of the year. We're going to multiply that by our interest of 14%, and that gives us total interest for the year of 8,715. Now, immediately you can basically say, well, my interest expense for the year was 8,715. And the interest, I'm going to debit this account with 8,715, and I'm going to credit that account with 8,715. And for income statement purposes, well, basically you're done. But should I have asked the statement of financial position? Guys, and it's only if I've asked the statement of financial position. I had to determine the outstanding capital account balance at the end of the year, and I had to calculate what portion of the 47,549 is a short-term portion and which portion of that loan is a long-term portion. So therefore I have to calculate the amortization table for the following financial year as well. My interest in the following financial year would be 47,000 on 57,549, which would have given me 8,057. My total installment is still 13,420. If I take out the interest portion out of the installment, I'm left with a capital repayment of 5,363. So at the end of next year, my outstanding loan amount is going to be the 57,549 less the 5,363, which gives us 52,185. Now in my statement of financial position, the 5,363, that would have been the short-term portion of the long-term loan shown as a current liability, as a line item on its own. And the 52,185 is going to be the long-term portion of the long-term loan, which would have been shown as a non-current liability. I say again, if you are only required to do the income statement, you don't even have to bother with that, because all you really need for the income statement is the outstanding loan amount in the beginning of the year. You have to multiply it by 14% to get to the 8,715. So in a tested exam kind of environment, Please do not hassle with unnecessary things because it's going to cost you a lot of time which you don't have, and you're not going to earn one single mark for your effort. Right, trade and other receivables. BTP only sells goods on credit to contractors and tradesmen who have been approved by the credit control section. BTP offers settlement terms of 5% if they pay within 10 days and they've got 30 days to pay, and records transactions assuming the discount will not be taken. What does it mean? It means when a credit sales transaction takes place, I am not going to have an allowance for settlement discount in my books. All sales to the general public and installations are on a cash basis only, and cash discounts are only allowed if approved by Mr. Storm. So never will I have an allowance account, and sometimes I will allow somebody who's going to pay me in a certain period of time to make use of a 5% settlement discount. Then, reviewing the receipts and debtors, it was discovered that during April, a local contractor who owned 13,680 Rand paid his account within the discount period. Mr. Rain, the stupid guy, debited the bank and credited the debtor with the amount received. Now, the first thing that we have to work out is what was the amount that we actually did receive. They've told us that he owed, so that was the outstanding balance. He owed 13,680, and then we allow him to make use of the settlement discount. So how much did we receive at the end of the day? 13,680 times 95%. So the amount that we have received is a total of 12,996. Now, he debited the bank with 12,996, which is the amount received, and he credited the debtor with 12,996. Now, what about the difference of 13,680 less 12,996? Am I ever going to receive that? And the answer is obviously no, 684 Rand. So we still have to pass an adjustment entry for that 684 Rand. That is a VAT inclusive amount. That is a VAT inclusive amount. So that is a VAT inclusive amount. So what are we going to do? We are going to debit sales with what? The VAT exclusive amount of 600 Rand. We're going to debit VAT with a VAT on the 600 Rand, 14% of that equals 84 Rand. And we're going to credit our debtors account with a full amount of 684 Rand. So if we go back to our trial balance, let's do that. We're going to debit sales. So if we debit sales, we're going to reduce sales. We're going to pass an 84 Rand against the VAT control account. Now again, they do not ask us the statement of financial position, so that's not really necessary to update the VAT control account as you go along. But what you should update is my debtors account. So the debtors account is going to be reduced with a total difference of 684. Why the debtors account? Because probably later on we will have to make an allowance for credit losses, because there you can see you have an existing allowance for credit losses. So probably you will have to make an adjustment entry. On 30 April 2016, BTB received 2 checks from JJ attorneys relating to 2 of their debtors. Mr. Rain had put the 2 checks in his drawer and no entries were made in the books. The first check was for 2736 and was for a debtor that had been written off in 2015. Right, so let's do the 2 checks here separately. Now, if that was for a debtor that was written off in 2015, we are going to debit bank with 2736, and we're going to deposit the check, obviously. We are going to credit losses recovered with the amount exclusive of VAT. And the amount exclusive of VAT equals 2,400, and we're going to credit our VAT output account with a VAT on that thing, which is 336 Rand. So if we're going to do that on your template, hopefully you've started off with a template for your income statement. You are just going to continue in your template. There is no credit losses at this point of time, so let's just add it. Credit losses recovered. So it is an income item, not an expense item, and that equals 2,400 Rand. Then again, it is VAT output, so it's going to increase our VAT account, but you don't have to do that because they didn't ask a statement of financial position. What did the guy do? Nothing. And bank is the other one, which is going to be 2736. So there's going to be a debit on my bank account of 2736, which I don't need either because I'm not required to do the statement of financial position. Right, now the second check. The second check was for Miss Cloud, a local tradesman who declared bankruptcy during the current year. The check amounted to 2,964, being 50 cents on the rand of the amount she owed. Mr. Storm accepted this as full and final payment, and the remainder of the account was written off. Good. Now, the amount that we received was 2,964. So we're going to debit bank with 2,964, and we're going to credit our debtors with 2,964. Again, the bank is not so important to do now, but 2,964. But debtors is very important to do because probably we're going to do something with that debtors account later on. 2,964. They tell us it was 50 cents in the rand, the 2,964. So that means it was half of the outstanding debt. Therefore, we have to write off the other half. So credit losses expense account or written off is going to be the VAT exclusive amount, which equals 2,600 Rand. We're going to debit VAT with the amount of 364, and we're going to credit our debtors account with a full amount of 2,964. So credit losses we need losses expense account, that was 2,600. We need our debtors with another 2,964, and just for completeness sake, I'm going to also adjust our VAT control account, and that VAT that we could have, it's a debit then so it's going to reduce that balance of 364 Rand. Good. Mr. Storm advised he wanted to reduce the allowance for credit losses to 4% of the outstanding trade debtors. Now, if we're going to have a look at our outstanding trade debtors, you will see that the outstanding balance on that account at this point of time would have been the 7680 less the 684 less the 2964 less the 2964, which will give us then a total there not equal to the 7680, but a total that equals an amount of 64,068. So 64,068 outstanding debtors, we're going to take out the VAT of 14%. Then we're going to multiply that, that equals 56,200. And we're going to take the 56,200 and we're going to multiply that by 4%. That is what we want the allowance for credit losses to be at the end of the year. and that gives us a total of 2248. We have an existing balance of allowance for credit losses. So the existing balance is 3534. We don't want that balance anymore in our books. We now want a balance of 2248. Allowance for credit losses makes the debtors balance less, so it reduces the debtors balance. What does that mean? It means it has a credit balance. So that allowance account, if you must draw a T account, has got a credit balance of 3534. I want that balance to be 2248. So therefore I have to debit the allowance account and I'm going to credit my income statement account, which is equal to, you can either do it against the credit losses expenses account, where you're going to reduce it in this case. You can never do it against credit losses recovered. You can only do it against the credit losses account, or preferably add a separate account, adjustment for allowance for credit losses. What we say here is going to be an income account, and that is going to be the difference there, which will equal an amount of 1286. So you're going to reduce this allowance for a settlement for credit losses, where it is. We're going to reduce that with 1286 in order to derive at the 2248. Great stuff. Now we've done that one as well. Next one. The prepaid advertising. Remember we had that funny thing in the list of balances. Prepaid advertising 4104. Now they tell us that the prepaid advertising relates to an advertisement that BTP took out in a local trade magazine for a period of 6 months starting on 1 March 2016. So 1 March 2016, so March and April, that is valid expenses. Expenses and prepaid expenses, as it's lying there, is not an expense. Prepaid expenses equals that 4104 is an asset account. So we have to take out of the asset account 2 months worth of advertising expenses. Mr. Ryan, idiot, credited the bank, which is right, that is with the payment that he made, and he debited prepaid expenses with the amount of the check. Now, what did he do with that? Absolutely nothing. So the first thing that we have to do is to determine what is the total amount of 4104. Oopsie. 4104 divided for a period of 6 months. Let's do that like this. Let's take out the VAT first. 4104 divided by 1.14 gives us a VAT exclusive amount of 3,600 Rand. 3,600 Rand for a 6-month period give us a total of 600 Rand per month. What is our advertising expense that we want to show in our books? Only 2 months worth of a VAT exclusive amount of 600 Rand, which equals 1,200 Rand. So what is going to be at the end of the day the journal entry that we're going to pass here? We're going to debit advertising expenses with the 2 months that has expired, 1,200 Rand. So that is a debit. We are going to debit VAT. That's what, guys? I've made the payment of 4104. So therefore, I'm able to claim the VAT on the full amount of the payment. And the full amount of the payment was 3,600 times 14%, which equals 504 Rand. So that equals 3,600 times 14%. Good. 3,600 is over there. So we're going to debit VAT with 504 and we're going to credit prepaid expenses with a sum total there of 1704. Let's do a sanity check before we going to do that 1704 entry. How much must actually be left in our prepaid expenses account for the prepayment of the advertising? We've said it's 600 Rand per month. 2 months has expired, so there's 4 months left. So therefore, I want a balance in my prepaid advertising expenses account of 600 times 4 equals 2,400. So if we're going to credit our prepaid expenses, we're going to credit, so we're going to reduce that with 1704. How much is going to be left here? 4104 less 1704 equals 2,400, and that is the amount that we want to show as a prepaid expense. So that is our closing balance. So we said we're going to debit this account or credit this account with 1704. We said that we're going to have advertising expenses for 1,200 Rand, which is 600 times 2. And the difference there of 504 Rand is going to be VAT input. So it's going to be a reduction against that account of 504. Which again you don't have to do because I don't ask you the statement of financial position. That is just for completion purposes. Then BTP rents a storage facility and pays monthly rent in advance on the last day of the previous month. The rent increases by 10% on the 1st of October of each year. This is the only rent that BTP incurs. So our total rent expense in our trial balance was 77,280. That 77,280 represents rent for a period of 5 months at a normal rent. So from the 1st of May, which is the beginning of our financial year, up to the, where is that? On the 1st of October. So the 1st of May to the 1st of October equals 5 months with a rent of X. Then we've paid 1 month in advance. So there was 8 months, total 13 months rent. 8 months that was paid at an increased rent of 10% of X. So there's our total formula, the 77,280. They don't tell you that they've done anything wrong. The only thing that Mr. Rain did wrong, Mr. Rain credited the, let me just make here. He rents storage on the last of the previous month. He didn't do anything wrong. So what he did is he just didn't take out the last payment that he made during the year and to put it to prepaid expenses. So that is the adjustment entry that you have to pass. X in this instance equals 5,600 Rand then. What is the amount that we have actually prepaid? Not the 5,600, but the 5,600 multiplied by 1.10 because that equals the escalated rent, which gives me a total of 6,160. So the amount that we want to remove out of our rent expense account equals the 6,160. You're going to credit this amount, 6,160. It's going to reduce the rent. We're going to credit it because it's an expense account. And under prepaid expenses, I'm going to add it there for, it's all prepaid expenses at the end of the day. So that prepaid expenses is going to go to part of that account there. Again, you're not required to do trade and other receivables, so that's not necessary that you update your prepaid expenses account as well. Then trade and other creditors. Mr. Rain, who knew his job was in jeopardy, was concerned about him and the inventory supervisor not getting paid for the month of April. He knew that there were no changes in the payroll from the previous month, so he simply paid everyone the same amount and debited the salaries expense and credited the bank for 28,840. So that's the only entry that he passed. He just paid the same net amount as last month, and in order to make that transaction balance, he credited bank and he debited salaries expense. You were able to ascertain the following for the month of March. The gross salaries for employees, 52,000 Rand. Then there was total income tax deducted, medical aid contributions. The employees contribute 7% of the gross salaries to a pension fund, and the employer contributes 5%. UIF contributions is 1% for the employee and 1% for the employer. Now guys, let's just do a little exercise here. If we're going to start with the 52,000 Rand, which is the gross salary, and we're going to deduct all the employee deductions, so the pay as you earn of 15,600, the UIF of 3,400, the pension fund contribution of the employee, which equals 7% of her gross salary, of 7% of 52,000, that then gives us a total of 3,640. That is pension fund. And then the UIF is going to be 1% of the gross salary, so 1% of 52,000 equals 520 Rand UIF. What would the net salary have been? If I do that calculation, it gives me the 28,840. So the net amount that he paid was 100% correct. There's nothing wrong with it. It is just the entry that went through the books that was wrong by debiting only the salaries expense only with the 28,840. Now the correction entry that we're going to pass through our books is going to look like this. We are going to debit salaries with a gross salary of 52,000 Rand. Debit. Then we're going to credit all the deduction creditors. So we're going to have a creditor for pay as you earn with an amount of 15,600. We're going to have a creditor for the medical aid, and that is going to be a total amount of 3,400. We are going to have a creditor for the pension fund, and that is going to be 3,640. That is a credit. Then we're going to have a creditor for the UIF. That is going to be 520. And then you will see that we are going to have a debit for the employer contributions. Now, what is the employer contributions going to be? To the pension fund, it is 5% of salaries, debit, that equals 5% of 52,000 Rand. That gives us a total of 2,600. Okay, 2,600. We're going to debit okay. Now that 2,600 is part, sorry, that one is not on the right side, it's a debit, 2,600. And we're going to have creditors for pension fund, credit, for the same amount, 2,600. We are going to debit now our UIF salaries with the employer contribution, which is also 520 Rand, and we're going to credit our creditors for UIF with the same amount, 520. And then you see if you're going to post the balancing item or the balancing figure, you're going to need here a balancing figure of a credit of 28,840. And what is that going to be? That is going to be the salaries. Why? What is that 28,840? If you can remember correctly, that was the amount that the guy has debited the salaries with when he made the payment. If you go there, he debited the salaries expense and he credited bank with 28,840. So if he debited the salaries expense and now I'm going to credit the salaries expense, here I've taken out his wrong entry. And by debiting our salaries with a gross amount of 52,000 plus the pension fund contribution of the employer plus the UIF fund contribution of the employer, then it means that I've rectified my expense accounts. And if they have required me to do the statement of financial position, all these credit entries except for that 28,840 would have been accounted against our creditors, trade and other payables. So for income statement purposes, what are we going to do with our salaries? For our salaries, we're going to add 52,000 Rand, which is the gross salary. We're going to add the total contributions, which is made by the employer, which is the 2,600, plus the 520, which is 3,120. And we're going to take out the incorrect salary of 28,840. And that is going to be all our adjustment entries against our salaries account. Right. Trade, yeah, at the bottom. Looks like the last one. During April 2016, Mrs. Heil, a non-VAT vendor, contracted BTP to renovate 2 luxurious bathrooms in a home. By 27 April 2016, all the tile paint and bathroom accessories was paid for and delivered to a house. It was agreed that the renovations would be completed at a total cost inclusive of VAT of 31,920 Rand. And the job would be finished during the second week of May 2016. Mrs. Heil paid a deposit of 11,628 and Mr. Rain debited the bank, which is right, and he credited income received in advance with that amount. At the end of April, 30% of the job was completed. Now let's quickly have a look at the income received in advance. Income received in advance, there's the 11,628. So the first thing that we want to determine is how much of that amount of in the contract can I actually recognize as income. Now I can recognize, let's do this. What was the total contract price? The total contract price was 31,920 Rand, but that will include VAT. So if you're going to take out the VAT, it gives us a total value of 28,000 Rand. How much of that 28,000 Rand am I able to recognize as income in the current financial year? It is a 28,000 Rand multiplied by 30%. The job was 30% completed. So I am allowed to recognize 8,400 Rand worth of income in the current year. Now, she has paid a deposit of 11,628. And that deposit includes an amount of VAT. So I was supposed to take out the VAT, and the VAT there times 14% gives us a total amount of VAT of 1,428. Now, let's rectify our income received in advance. We have to debit income received in advance. With what? Well, first thing that we want to do is we have to pay over the VAT of 1428. So we have to credit our VAT control account, it's VAT output. We have to credit that with that amount of 1428. Then we know that we can recognize income, and there we've worked out the income that we can recognize for the period, for the 2 months. So in this question, I think they call it installation income. Of how much are we allowed to recognize? We are allowed to recognize 8,400. So what is going to be the debit against our income received in advance? 9828. Now, if we're going to do that entry, we're going to debit income received in advance. So we're going to reduce that with the amount of 9828, which is in this case also not required. Why not? Because we don't do the statement of financial position. What I actually have to adjust here is my installation income, that I'm going to increase with the amount I can recognize, 8,400, and the other one is also not really required to do, and that is your VAT control account. It's going to be credit against VAT control of 1428. And then we've done all the adjustment entries in the question. Let's quickly go and have a look at the final answer. Right. Income statement. Both Tile Eng statement of profit and loss and other comprehensive income for the year ended 30 April 2016 Rand. Sales. Now if you go back here, 3450,500, the original amount. And then we had a small adjustment against that of 600 Rand, and that gives us the final amount. Cost of sales, we've already spoken about. Gross profit, then the difference between the two, 1982,200. Other operating income is our installation income. Now it gave us the 980,000 Rand plus the 8,400 Rand, which gives us now the total there, 988,400. And then we had credit losses recovered, which we have entered here at the bottom of the trial balance. Credit losses recovered as an income item, 2,400 Rand. I would have preferred if you also showed as an income item this adjustment against your allowance for credit losses of 1286, but what they've done in the memo for this question and for many other questions, they have just subtracted that amount from the credit losses expense account, which is not wrong, but it is maybe better, especially for the second semester purposes, that you've shown it separately in your statement of profit and loss. Right, then our expenses items. Freight on sales, that was just from the trial balance. We haven't done anything about that. Freight on sales. Freight on purchases, we've done under cost of sales. Consumables is the difference between that. For salaries and wages is with those adjustments that we've passed. The 2310 less to, yeah, okay. So that is the lot that we've passed against that. The depreciation expense we haven't done anything with, so it's exactly what they gave us. The rent expense is after we've passed the adjustment there of 6160. Our selling expenses we haven't done anything with. Our other admin expenses we haven't done anything with. Our credit losses, here they've subtracted the 1286, that's the adjustment account. And then the other 2,600 is also the write-off that we made again, during the year of 2,600 Rand. So there's that amount. Here's just a long calculation, which we've already done. Advertising expenses, that is 1,200 Rand. We've already done that one. Here it was 1,200 Rand. Then our stationery use, that was the difference between our opening inventory and what we still have on hand at the end of the year, which we have also added here, stationery, 7,800 Rand. And then lastly, Our interest income was 30,800. That is exactly the same as what they gave us. It was that 30,800. Our interest expense, that was the 8715, which we have actually calculated in our amortization table, 8715, and then it gives us profit for the year for 1474,372.